Hey folks, Dan Frio here with your closing bell for August 23rd, 2024. So we saw mortgage rates ease a little bit more today. They're going to go even further. Why? Well, the Federal Reserve came out in Jackson Hole and they basically said everything but they're going to cut rates. So there's an interview on CNBC. It's kind of about 5 or 6 minutes. This is packed with everything you guys need to know. They talk about what's going to go on with rates, when rates might cut, how much they're going to cut, and why they're going to cut. So this is Goldsby. He sits on the Federal Reserve here in Chicago. He had an interview with CNBC. I want you guys to listen to this because this is packed with everything we've been waiting for. It's kind of a Goldilocks day. We have the markets, all the equity markets up and up considerably. We have cryptocurrencies up quite a bit. We have oil. Unfortunately, oil's up. That's going to push up inflation just a little bit. But otherwise, mortgage rates are coming down. So it's not a bad Friday. I'll take this. So check out the video and then we'll come back. I'll put it in layman's terms and break down a lot of the things that he said. So without further ado, let's get over to the interview. Take it away, folks.
Very much. We are here with Austin Goldsby, the Chicago Fed president, with a nicer background than we normally have.
Yeah, can't beat that. Reminds me of Chicago.
Exactly. How so? No, never. Fed Chair Jay Powell saying today, the time has come to adjust policy. Your general thoughts, do you agree with that?
Well, it was very forward. It was very clear. I thought he gave an excellent speech. I usually don't like saying tying our hands, before a meeting. But I've been saying for some time, if you take the level of tightness that the Fed has set, Fed funds minus inflation, that's as high as it's been in decades. And you only want to be that tight on purpose if you're trying to cool an overheating economy. And this is not overheating. So I think the general notion that we want to be careful, as Chair Powell said, about the employment side of the mandate too. We're not just fighting inflation now. Inflation's on a path to 2%. I totally agree with.
You're one of the originators of this idea of what I guess people call passive tightening. Can you explain that to people, why that matters and how that's happened, that you've gotten tighter?
The basic idea is what matters for the economic decision making of if you're going to build a factory, if you're going to buy a durable good, what have you, is the interest rate you pay minus the inflation rate. So if inflation is growing faster than the interest rate, right, in real terms, your debt service cost is going down, if you want to think of it that way. So that real interest rate is a measure of what's the actual tightness. And so if you set the rate at some level and then inflation just keeps going down and down, every time inflation comes in less than what you expected, you're tightening. Right. And that means right now we're the tightest we've been over this whole rate.
Even though you stopped hiking rates in July 2023, you've been putting more and more pressure on the economy.
More and more as the inflation has come.
So let me just show you a little caption. I just went to, you guys know I love ChatGPT, and I put it in there saying, what's the current spread? And you can see that in the information right through here. So let's go at the top. What is the, where did we go? Let me scroll up to the top, and it says right through here. I went up to the top. What's the current spread between the federal funds rate and the inflation rate right now? And it is right through here. Right now we're at 5.25 to 5.5 on the federal funds rate. Inflation's they're saying is 3.2, so it's about 2.3% the spread. If you go down through here over history, when other times in history were we at this big of a spread? In the 80s, there was a big spread there. In the 2000s, I don't think there was a spread there, but it looks like two times in our U.S. history has the spread between these been this big. And that's why I keep saying it's not normal times, folks. So, how you figure out mortgage rates normally is you take the 10-year Treasury and you add, 1.5% to it, and that's the mortgage rates. There's a disconnect right now, and that's what he's speaking about right here in this interview. So just wanted to connect the dots there, but the spread between the federal funds rate and inflation right now is basically at the highest level or second highest level ever in history. So that, just to bring that to a point.
Come down. And the thing is, we set the rate more than a year ago, and the conditions were really completely different. And you saw Chair Powell talking about that. He just kind of walked you through the history in a very clear way of how different conditions were 14 months ago.
Right.
And so I still think, not just for this meeting, over the next calendar year, let's say, I think it's worth looking at the statement of economic projections that the committee has been putting out every 3 months. In those statements, there's widespread agreement that there will be multiple rate cuts over calendar years 24 and 25. Inflation will.
So if people say they haven't said it, basically he just said it. There's going to be multiple cuts from starting in 24 through 25. So if people don't say, oh, they're not going to cut, well, there it is, folks. So keep going. Sorry about that.
Be coming down, and the unemployment rate would be creeping up a bit and settling in. And it's worth noting that that's under conditions where the inflation rate was coming down slower than it's been coming down in the last several months, and the unemployment rate is already a bit higher than it was. So I kind of think this moment, I thought the spirit of Chair Powell's speech of, look, this is the moment. Everything that we've been wanting to happen, this is the path to that happening.
Right. So what does that path look like? How much tightness, how much extra tightness is there in the economy right now?
It's hard to put a specific number on it, but to me, it doesn't look neutral. I mean, you've got the unemployment rate drifting up above what people thought was a steady state rate, not even just a few months ago. Now, hopefully that turns out to be a bit of a blip. It was an unemployment rate increase that wasn't driven by an increase in layoffs.
Right.
So maybe it would go back down, but that.
What he explained there, and I apologize, folks. I try to jump in here because even I question some of the things that they say. So when he said the unemployment rate went up, what happened is the participation rate increased. And so that basically more people basically voted, I guess, put it that way. And that's what ticked up the unemployment rate. However, a lot of the factors, remember yesterday, I think it was yesterday or the day before, we had the new analysis come out with the 816,000 jobs. 816,000 jobs basically vanished. So that's going to tick up the unemployment rate as well. So the employment side of the equation is starting to get on the shaky grounds, but I don't think we have any shakiness and they're going to be cutting rates. So sorry for the clarification again, but I want you guys to understand all this.
Taking the job market in totality, I think that's a critical thing for everybody to do. That's certainly what I'm trying to do. And by almost all measures, the job market is cooling, and we're in this thing where it's like it's cooling and it's supposed to settle down at normal, either what it was pre-COVID or something like that. And how much confidence do we have that it's going to stop there? Or is it going to keep?
So let me ask the question more directly, Austin, which is the market has 100 basis points priced in for this year in terms of cuts, another 100 for a full 12-month period. Are those aggressive? Are those neutral? Are those right?
I guess I would just say, I don't like committing ourselves of what will be the rate cuts at the next meeting. This sounds like 5 meetings from now.
Yeah, and there's a piece of paper I'd like you to sign here.
The statement of economic projections and the dot plot, I just encourage everybody go look at it. We've been we've been trying to transmit each individually reaction functions, and they show multiple rate cuts over the next calendar year implicit in those projections.
What happens if you get stuck at 2.4% inflation? If it doesn't come down, if 2.5 is the best you're going to do and you're cutting rates and you're stuck?
Look, it's a hypothetical, and in that hypothetical, it depends what's happening on the other side of the mandate. But let me just emphasize, I don't think that's going to happen. There were a group of people saying we're going to be stuck at 3, and they were so convinced we'd be stuck at 3, they said the Fed should go change the target and declare victory because we would never get below 3. We never stopped at 3. If you take the new months coming in, I think the inflation expectations show you that the market does not believe that we're going to be stuck at 3. or 2.5.
I want to get back to your comment at the very beginning. The Fed chair said rate cuts. Has he locked you in or locked the committee in, pre-committed?
I don't. You know, I'm not allowed to speak for anybody else on the committee.
So
I don't know.
Do you, Austin Goolsbee,
You're asking me what am I for, and you know I try to resist committing myself. Here's how I'm going to say or what I'm going to vote.
He has talked about the idea that rate cutting is a process. You wouldn't do one, he said. You would do a series one. Do you agree with that idea, that rate cutting is a process?
Historically, it has been a process for sure. And if you look at the dot plots, it's clear that a large majority of the FOMC, if not every single member, believe conditions are going to warrant multiple cuts over the next 12 months. And both of those things I feel pretty confident about, but what drives the decision are economic conditions. Conditions could change, and that would be different.
Austin, we have to go, but give us an idea if we have a chance to sit down here next year. What's the economy look like?
No, you just want me to commit to
something. No, I want to know what your best outlook is here.
I want, my best outlook, what I want is that we hit the golden path, that inflation comes back to 2% and we don't have a serious recession. I do have concerns. There are concern warning lights from parts of the job market and the consumer delinquencies, small business defaults. On the other hand, we also have wide pockets of strength in the economy. So I'm hopeful that a year from now, we're still chugging along.
Predicting is hard, especially about the future, as Yogi Berra said. Austin, thanks for joining us today.
Great.
Perfect. It was perfect. Okay, so now let's get to something over. Let's see. Let me go to show you what the dot plot looks like. So let's go in here, CME FedWatch tool. I'll go to this, go to the FedWatch tool, and it shows on here the CME FedWatch tool. There is a dot plot so you guys can understand it. So just Google the CME FedWatch tool, go to it. You're going to see down through here what the dot plot looks like. My bad. And here's what he's talking about. He's saying, so in 2024, what the dot plot is basically every meeting when the Federal Reserve meets, any member of the Federal Reserve could sit there and put a dot on where they expect the federal funds rate to be. So here's where the dots are right now. Okay, so in 2024, the majority of people have it at, let's say, between 4.75 and 5.25. Okay, so that's where they have this year's dot plot. Then next year, 2025, the majority of them, not all of them, he said maybe all of them, but there's one person up here, the majority have them right through here at about 4.25. Okay, is the federal funds rate. That means currently we're at 5.25 to 5.5. So if we go to 4.25, that's 1 full percentage cut in the federal funds rate. And that's what he was talking about there. So let's get over to the general markets. Markets are loving this thing. We got the Dow Jones up almost 400 points. S&P up 447 points, NASDAQ up over 200 points. Russell 2000, again, remember I said a lot of people are shifting their money into smaller companies, and that's the Russell 2000. So if you're interested in putting some money somewhere, you might want to do some research on all these indices. And then in cryptocurrencies, it's way up there again. So that's what we're seeing in the mainstream markets. So this is actually causing people to feel wealthier. If you own cryptocurrency, you're making a lot of money today. If you own any asset class on the long positions, you're making money today. Okay, so that's where that is. And that's it for today, folks. And that's it for the week. We had a fantastic, it's a great way to end the day. We have all the markets basically going in a good direction. Let's go back and take one last glimpse at what the bond market's doing. We have the MBS market up 25. So that's going to continue to reduce rates. So that's a big enough move that this could go down basically to 6.4, maybe in the 6.3 range. Let's refresh it. Nope. So we're probably going to see in the 6.3s. Maybe can we hit 6.25 next week? That might be it. So join me next week every day to see where these rates go and what's causing the effects to happen. So how do you reach out to me, or what do I do? I'm a loan officer. I'm actually licensed all over the country. So it's very rare that a loan officer is licensed nationally. I am. And I'd love to help you. So if you're out there trying to buy that first house, maybe an investment property, or maybe looking to refinance because rates are way down from where they were, check out the rateupdate.com. This is my website, and you'll find out all the information you need to know to reach out to me for some assistance. And if you can't find it on the page, just give us a call. You can scroll down here, and you're going to reach us at 844-775-5626, or you can email me directly. Yes, it's me. It's not a bot or anything else. It's me, and it's Dan at therateupdate.com. Thanks so much for watching, guys. God bless. Have a fantastic weekend, and I'll see you back here first thing Monday morning. Take care. Bye-bye.